Stock options and other complex trading strategies has exploded over the last 10 years. And no, it isn't just sophisticated hedge fund pros or portfolio managers with decades of experience driving the action. It's mom and pop, you right there at home, diving headfirst into the world of options and the leverage that comes along with it. Who can blame them? When you get it right, it's like hitting the lottery. Why settle for 5% in a trade of Microsoft when you might make 5 times that in the same amount of time? Even the strategy names are exciting. Bull and bear spreads, calendar spreads, butterfly straddles, strangles, and my favorite, the iron condor. But what happens when you don't get it right? How much risk are you really taking? And maybe more important, what can we do to limit those risks? Well, let's find out with one of the best in the business, Jeff Tomasulo, co-founder of Tactical Income and CEO of Vespula Capital Management. Welcome to The Money Runner. I'm David Nelson. Jeff, welcome to the show. Thanks so much for being with us today.
David, it's good to be here.
You know, it's been really too long, and I've been watching you guys on Tactical Income, and it's an education. I will tell you that. You know, I learn a lot watching your show, and it made me think about options and how they've exploded, you know, really over the last decade. But as a fiduciary, as a portfolio manager, and as an advisor, and somebody who speaks, you know, maybe to an audience, I guess one of the biggest concerns I had is that retail traders might be intoxicated with the potential for big gains. What do you tell investors, maybe when they're starting off, just getting started, how to maybe, you know, position that mindset and not go over the top?
Well, you know, you said it in the beginning of your intro. It's all about education. Education. And that is the problem with any part of our business, David, is the fact that everybody's so starry-eyed about the upside that they never think about the downside. And what we teach at Tactical Income, the way I manage my portfolio at Vespula Capital, it is always about capital preservation first. And for the retail investor, I understand. I want to make as much money as I can at every trade I want. But it really comes down to managing the risk, and options do it better than anything you can imagine. And if the retail investors, if advisors like you really truly got educated in options, you would understand that, hey, this is a great tool for everybody to use in their portfolio, not only just to make money, but also to protect their money.
So I look at this from you know, we too often look at this from the retail side and the individual investor at home and understand, you know, they're learning something, but even pros get it wrong. I've seen,
100%.
You know, some pretty smart guys blow up. I can think back to my days at Lehman, and there was a team on the desk of guys, pretty bright guys, doing a lot of hedging strategies, a lot of option strategies, a lot of spread strategies that we're going to talk about in a second. And they left to start their own shop. I was going to be following a couple of weeks later, and we were going to be at the same building. And a couple of weeks later, I was walking in, they were walking out. They were already out of business. In the space of 3 weeks, they had wiped themselves out. What's maybe the number one thing that both retail and professional investors get wrong when first working with options?
Well, there's two things. One, everybody, and you see this all the time, they all trade way too big, right? And if you're going to use a product that has inherent leverage, right, and we'll talk about leverage in a second when it comes to options, if you're trading way too big, well, guess what? You're going to end up in a heap of trouble, or you're going to blow up your account. And that's why we see so many people who start with options blow up their accounts. One of my tag lines that I use to our students is you trade small. You trade small because when you have the type of leverage in certain option strategies, that options allow you, you don't need to trade that big, because when you're right, you said in your intro, you get the way options are set up, or certain option strategies are set up, you can make a lot of money. But the other thing is that I don't think people truly understand, and this again, and you're going to get sick of me on this channel, on this interview, because it is all about education. Because when a lot of people, and especially retail investors, but you said it, even big smart Wall Street people get it wrong, is the fact that they don't understand about probabilities. When you're taking these trades on that have this huge upside, those are low probability trades. They don't work out all the time. So if you're investing way too big and it's a low probability trade, you're going to lose more often than you win. And that's not a good thing.
Maybe start off with, let's define what an option is, because for a lot of people watching this, maybe for the first time, maybe not exposed to the world of options, why don't we start off with just maybe a very simple one? Let's just discuss what a call and a put is.
Well, a call option, right? If you're buying, this is a big difference, buying and selling options, right? If you're buying a call option, all an option is like a contract, like any other contract, whether you're buying a house, right? It's saying you're going to buy at a certain price at a certain time, and then the owner of that house has to deliver it. And that's the same thing as an option contract. A call option is basically saying you have the right to buy a stock, whether it's Apple, Amazon, at a certain price within a certain time period. That's basically all it is.
So then the biggest risk of that I would see, and maybe we could talk about this, is one, inherently this has got to become worth less and less as the time disappears, because you're running out of time. Can you talk about that?
Yeah, that's the big catch, right? Is with options, right? When you're buying an option, you have to be right about the time period, because you have this thing called theta decay, right? It's a natural, every day that the stock doesn't go through that strike, you're losing money, right? So that is also why it's so important to understand when to buy options and when to sell options. I mean, David, that is one of the most, if I'm going to say anything on this show, is the fact that people don't know when to buy or sell options. I mean, to the point where at my firm, we created an algorithm to be able to allow us, right? It tells us when is it a good time to buy and sell options. And it all comes down to the most important thing, right? When you're an option buyer or seller, you need to understand where volatility is. When volatility is high, that means option prices are really expensive, and you don't want to be buying when stuff is really expensive. And when volatility is really low, that's a really good time to consider buying options, because option prices are really cheap, relatively cheap. And when you can get that, when you can put context around volatility and you can put context around price, you become a much more successful options trader. And not many people do that. Not even the pros that we hang out with or we talk to, David.
Maybe you can walk us through something, what you would consider a relatively, I guess nothing's safe in this world, but maybe let's start off with something simple, either a covered call or maybe a simple, bull or bear spread. Maybe you could walk us through what those look like.
Well, here's a simple strategy that we start everybody off with, right? Okay. At Tactical Income, because direction, and you know this, you're a portfolio manager. Picking to whether Apple's going to go up or down is really hard, right? And this is the beautiful part about options, because you could create an option strategy where you make money when Apple goes up. You could create an option strategy where you can make money when Apple goes down. But the beautiful part about options, and this is where I make probably about 60 to 70% of my trades, is I create an option strategy where I make money whether Apple goes up, down, or sideways. And that is, like that. To me...
All right, you got to walk me through that one. So you're telling me that I can make money no matter what happens?
No matter what happens. And here's the beautiful part, David, which I can't believe, because everybody is so enamored with the upside of options, right? The the way people did this during the meme craze. You've heard of the meme craze, right? You had GME, you had AMC. These stocks were going crazy. People were buying way out of the money call options, and they were lotto tickets, right? But they were low probability. Well, I flipped it on the other side. I said to myself, I want high probability trades. I want to make money whether the stock goes up, down, and sideways, and I want to define my risk. And what do you mean by define my risk? I want to make sure that if Apple goes to zero, well, I only lose X amount of money. I mean, that's pretty powerful stuff right there. So what we like to do is we like to put context around volatility, and we like to put context around price. And we use a strategy. We basically sell put spreads and call spreads, but we do it very tactical, right? We do it, and that's why the name of my company, Tactical Income.
Okay, so you got to stop right there. You're talking bull spreads and put spreads, but you got to give us some context as to what that actually is.
So basically, all that is, and I'm selling them. This is the huge difference because many people buy. That's all a lot of retail investors do. We're selling options, and the reason we're selling options, and this is basic right here, is that every day that passes, instead of me losing money, when you buy an option, you talked about it. You have 30 days, 45 days, 60 days. And if you're buying it, you're losing money if that stock doesn't move. The opposite is when you sell, that money comes into your account. You're getting $5, $10, $20, depending on how big your position is, as long as the stock stays where it is. And what a spread is, all you're doing is you're selling a call or a put, and you're buying a call or a put at a certain spread, right? So if it's 1 point, 2 point, 3 points, like this, let me give you an example. So with Apple, if Apple is trading at $180, right, I'm going to go and sell the $175 put, and I'm going to buy the 170 put. And what that does is that defines my risk. All I could ever lose on that trade, if Apple drops to $100, I'm going to lose the width, that's 5 points, minus whatever I receive as premium, which is what I'm selling the option for. So if I sell it for $1, all I'm losing is 4 points. So Apple could go to zero, and I sold the 175s and I bought the 170s, and all I could lose is $4 because I received $1 in premium, which means that dollar is coming into my account. I am making $1 on that no matter what, but I'm going to lose $4 if it's all the way down to $100 or $140 or zero.
And let's define that, because so many people, I see this, even professionals, they look, they almost think of it as like free income, and they sell these, what I would call out of the money puts on stocks that, yeah, they'd be happy owning it until they own it. Right. And then suddenly they own it, and they're owning it for a reason, because it's probably going down hard. And suddenly that what they thought was a free income or a free dividend on the stock has now become a liability.
That's also doing naked, right? So selling naked puts, and this is how people get themselves in trouble, right? When you sell naked puts, or you sell, and I use naked meaning the fact that if you sold the 175s, right? We just gave an example on Apple, right? If it drops from 180 to 170, now you have the right, or no, you don't have the right. You are going to take Apple in at 175, and that causes a lot of problems.
You sold insurance to somebody else, basically.
Exactly, and that person is like, hey, I want that insurance, and they're going to give you the stock. And what is going to happen there is the fact, and this is why with smaller accounts and even big accounts, but when you have a much larger account, it's easier to take the stock in and deal with there. But when you're trading with 15,000, 10,000, 50,000, 100,000, and I tell this to our clients and our students all the time, there's no reason to sell naked. Yes, the reason why, David, people do this, again, this comes down to greed. People want to make more money because you collect more premium. Right? You collect more of that, what you're selling an option for. And again, it comes down to greed. When you could put context around price, you could be much more tactical at when you put your positions on and when you don't, or when you take your positions off and when you don't. And that's the same thing we do about everything we do. I think anybody, when they're investing, David, they should be able to put context around and then explain to you or me what their edge is.
Let
because
me
if
push
you
back
could do
just
that, you're going to be so much more
Let me push back
successful.
just for a second, and let me play devil's advocate here. Not to go against what you're saying, but
No, but go for
I've
it.
seen
I love it.
some real statistical anomalies really develop over the last several years, a lot since COVID. And in some ways, market structure has changed. And the moves seem much larger than they have been in previous years, especially as you go down in market cap with the smaller names. It was a time, I go through earnings season, once a quarter, and I've got to be on these conference calls, and I see the price action that happens the following day, or even in the aftermarket, and it ain't small. It's not uncommon. It's not uncommon to see, stocks move 30, 40, 50% in a move. Just the other day, we saw SMCI literally move up 50% off an earnings report. And then the following day, move up another 20, all right? And then somebody downgrades the stock, it goes down 20. These are not small moves. And I'm just wondering, in the context of that massive volatility, how do you deal with that?
Again, the beautiful part about the options, which I guess people, and I'm trying to be a big proponent of it, is like if you're creating the right option strategy, and we talked about it briefly in the beginning of this, about defining your risk. So the way I look at markets is that I can't control that, right? David, you can't control that. We have no idea. I love when people come on shows and they sound like they know what's going to happen in the markets. And you and I know that's kind of BS, right? So what I have learned over my 27, I'm going to be almost 28 years now, David, on Wall Street, April 1st, right? 2024.
Wow, if you're on 28, then I must be on something longer than that. So I'm feeling pretty old.
I know. But what I realize is that, and I'm trying to get this through to people, is you can only focus on what you can control. I can't focus on what the Fed is going to do. I can't focus on how the market reacts to SMCI, which blew my mind. I can't control what happened to GME and AMC and all the memes and Bitcoin. But you know what I can control, David? I can control what I invest in. I can control the size. And that is the huge difference. When you ask about the massive moves that we have, it's the size of the position sizing that we put on. You can control that. You can control the type of strategies, right? That's the difference between people who just trade stocks and people who use all the tools that are out there for them to help not only grow their wealth, but also protect their wealth. So with option strategies, I can make money when the stock goes up. I can make money when the stock goes down. I can make money when the stock does nothing. Right? Using those three strategies and being able to define my risk, which controlling my size, allows me to navigate this extremely volatile world so much better and so much more efficient than I would if I just used a buy a stock or sell a stock, right? I want to be able to use all the tools out there to be able to help me grow my wealth and protect my wealth.
Let's stop right there for a second, because you just said what I thought was the most important thing that people can take away from this program or this podcast. You mentioned size. Let's talk about that, because that's what I see as the biggest problem out there. Let's talk about nominal exposure and how much you're really controlling when you go in. And let's use an example of Apple. You're buying, an at-the-money call of Apple. I don't know, ballpark, what do you think that would cost, going out 30 days right now?
Well, I could actually probably tell you, but it's probably going to cost you about $4, right? So,
all right, so $4, let's put that in dollars. What is that in dollars?
So for one contract, which you get to control 100 shares of stock, right? One option contract, right? And if you go at the money, let's say 25 days, I'm trying to pull it up for you right now. It's actually a lot. It's $5.85 at the money Apple call right now. So for $500, right? For $500 or $600, let's say, you could control 100 shares of Apple. Instead of paying for $181, you're paying yourself. What is it? That's $18,000.
$18,000. But so with that, you're controlling. All right, buying that call, for around $600 is the same as me buying 100 shares, paying $18,100 for that stock. That's how much you're controlling in there. And imagine if you went out and bought $18,100 worth of calls for that one stock. I ain't going to lose all my money in Apple. All right, I'm not going to lose my $18,000. I might lose money, but I ain't going to lose $18,000. But if you did that with the calls, you could lose it all.
Right. Now, let's put this in perspective too. You can buy and sell a call, like how you, David, people use stop losses. So if you only say even if you did do the $18,100, you could say to yourself, hey, I only want to lose $1,000. I want to lose. Now, obviously, it's a lot tougher. But what too many people think, and this comes down to education again. Do I hold a call option when it's not working for me to expiration? No, you don't. You don't lose all your money. And again, it comes down to size, David. You're not going to be putting $18,000 into Apple. And too many people do that, right? Too many people go way too big, their call options, not realizing the intricacies of how much the underlying, which is Apple stock, needs to move for the stock price, for the option price to move, right? So there's a lot of intricacies. But again, once you get educated on all this, it really gives you the power, right? Because to me, again, I want to use all the tools necessary. I want everybody out there that these tools are out there to help them grow their wealth and protect their wealth. And if they can educate themselves properly, my God, it opens a whole new world for them.
Probably one of the challenges of options. You're in a position where you've got to explain what seemingly seems really, really complex, but when you define it down the way you do and get it down into some of its basic components, it becomes easier to grasp. And I think that's really part of the problem that you have to deal with when you talk to the people you're trying to educate.
Oh, all the time. Because I think everybody learns about stock immediately somehow, right? They just, I buy means it goes up. And you hear about puts and calls, people, their brain has a hard time. And to me, it's just repetition. Like when I go to Starbucks and you got to order all those freaking crazy ass drinks for the first 5 years or first year, I was like, shit still doesn't make sense. Now I understand everything with Starbucks. So for people who's learning, it's just really it's repetition, and then visualization.
What's the first mistake that your students make when they get started on themselves? What's the most common mistake?
What's the most common mistake is that they think probabilities work all the time and they go big. They get so big. They're like, I have a 90% probability it's going to work. And I'm like, dude, you and I both know that shit does not work out that way. And I have to tell them that it's dynamic, right? When they look at the 70, like right now it's an 88% probability. Tomorrow it could be 70, right? Because the market is changing all the time, right? So they have to, that's why people don't like defining their risk, because to get that 88% probability, if you do naked, it's 70, you're going to make $70. If you do a spread, you're only going to make $38, right? So they want the $70. To me, I want the $38. I don't care about the 70 because the risk is too great, right? So I'm constantly willing to take half of my profit, but define my risk, right? I don't need to take many positions on. Instead of you have a bunch of positions on. I decided the opposite. I'm going to be so tactical, wait for the right setups. And then when I do catch the directions, I make it so much more money. And I have the overlay where I'm making 10 to 15%. That's why I'm making
all right,
for the last 5 years.
So you convinced me. Maybe it's time for me to have my agent talk to your agent. And
you should.
We'll have a Hollywood marriage here. That was great stuff. By the way, that was Jeff Tomasulo, co-founder of Tactical Income and CEO of Vespula Capital Management. And this is The Money Runner. I'm David Nelson.